Hello, how are you doing? Welcome along to our weekly catch-up live stream here at FTUK. It's good to see you. How's your trading week been? I hope you've been managing to survive. There's been so much happening in the markets, and definitely those non-farm payroll numbers. Gosh, they put the cat amongst the pigeons. Yeah, things can feel like they are collapsing around you. And so I thought, well, for this live stream this week, I want to just do a bit of a workshop on context, putting some perspective around some of these moves, because when you're new to markets and you're new to trading and you're maybe in your first prop trading account, it can feel like, oh, I don't know what to do, and you can feel a little bit like a rabbit in a headlights, and everything around you is so noisy. Everybody is telling you what's going on, everyone's panicking, and you know, you've really got to put some context around some of these moves. So today I want to do that. I want to break it down in some and talk about in detail some of the things that most people won't tell you that you need to consider when you're tackling markets like this. But before we start doing that, everything is changing at FTUK, and I want to highlight that we've got a change coming in the next couple of weeks. So all of our accounts are changing. Everything is a new website. The whole thing is changing. So we've got a sale on at the moment, 30% off all of our main accounts. If you like the way that we currently work, then this is a great opportunity to get a huge discount on any of our accounts that we've got on our website at the moment, from the 14k all the way through to the 90k, whether that's a one-step or an instant funding account. So please do head over to the website, and over the course of the weekend you'll be able to get a huge 30% off any of the accounts. It ends on Monday, so please do take advantage over the next couple of days. Yeah, also as well, don't forget to, I must not neglect to say that you are welcome to get into our Discord. Please do join Discord. We've got a great community on there. It's where all of the key information, anything that's major happening in the markets or happening at FTUK, that's usually the first place that you get to see it. So please head over, scan the code, and have a chat with some of the guys in there. It's a huge, fantastic community, about 3,000-4,000 people now. So yes, and hello to everybody on Discord. Hope you've had a good trading week and have managed to survive. So let's talk about what we need to break down today. I'm going to do this in 4 sections. I'm going to talk about understanding the market noise around you. It's very important to do. I'm going to touch on the concept of what a market crash really is, what it means to you as a trader, and how you define it. You know, it's one of those terms that's banded around, and there's very few people that can really understand and define what is a market crash. Exactly, tell me what it is. So I want to discuss that. Catching falling knives, if you've never traded before, or if you're quite new to it, then maybe a term you may not have heard of, but it tends to be the death of most retail traders. So I want to touch on that as well. And then also I want to just talk a little bit about who are the best kind of prop traders to handle these market conditions. There's no secrets in there. It's pretty obvious, but you know, prop trading is quite unique, but usually because you've not only got to contend with the market dynamics in front of you, you've also got to be able to contend with the rules of the prop firm too. So it is quite specialized in that field, and some prop traders handle these conditions better than others. So what are those factors? Okay, so let's start and let's talk about understanding the market noise around you. It obviously has been volatile since those non-farm payroll numbers came out, showing that the interest rates are now pushing on inflation, and then that has now had a knock-on effect onto the US jobs market. Those numbers starting to come down, unemployment starting to rise just a little bit. And what happens is everybody panics, the markets are at highs, and it all comes tumbling down, and it can feel like we are going to hell in a handcart if you believe what's said on Bloomberg and CNBC, all the online forums. Everyone can tell you that it's doom and gloom out there. Get out of the stock markets, sell everything that you've got, and that's it. Go back to harbour. Now, what that thinking always defines, because it's very loud, it's a very loud, noisy environment to be trying to then make your own trading decisions in. What it always does is nearly always indicates is based on rate of change, because what we're looking at is we're looking at markets that have moved a particular distance very quickly, or they've moved the distance in a much shorter time in the downward direction than they did when they were actually making that move in the upward direction. But that's nothing new in markets. That's been around since markets were invented. Markets tend to move back in the other direction a third of the time that they did to create the move initially. But what you've always got to do is you've always got to do your own thinking. So if you look at this chart here, just look at a couple of them. So you can see this here. This is a daily time frame here of the NASDAQ, one of the thinnest indices that we've got to work with. And you can see it's basically this. So the rule of 2/3 and a third works quite well in this instance. You've got roughly 2/3 of the time to make the move, and then 1/3 of the time roughly to then row back and retrace the entire move. So that in itself, it looks like normal market behavior. There's nothing strange about that. But so when people start talking about markets crashing and doom and gloom, what they're really saying is this rate of change. The rate of change as we come back down it's collapsing, and it makes everybody panic. If you look at the dollar against the Japanese yen, it's even a little bit more pronounced, but maybe it's a little faster, but essentially we've got the same thing, and it's the rate of change that you are coming back down. That is what causes people to start to panic about their positions. But, as you'll see in a second, the dollar against the yen is quite unique for several key reasons, primarily because of the interest rate differential and the carry trade starting to potentially unwind, but we'll touch on that in a second. So that's basically what that noise is around you, and everybody on all the mainstream media, they shout it from the rooftops, and it's designed to sort of maybe knock you off balance, get you out of your position, the usual kind of thing. But as a trader, I've been doing it a long time, so there should always be a bit in your mind that talks, that says to yourself, okay, this is what I'm being told, this is what everybody's doing, should I just have a look in the other direction? And the answer to that is yes, you should. Just for context, because it's a very important thing to do. So what I've done, this is an exercise that everybody can do. Look at any of those daily timeframes on the major markets, the markets that you're probably involved in trading, on a day-to-day basis, and have a look at the size of the move. And TradingView is a really good tool for doing this. You just get the measuring tool, the ruler, and just look top to bottom on the move. I did that this morning, and this is the size of the moves. We've got a 7% move on the Dow Jones, a 10% move, which is quite a reasonably big move on the S&P 500. The NASDAQ is definitely worst, 16, just under 17% top to bottom, but it's also one of the thinnest markets, and it's also tech-heavy, which is NVIDIA, and NVIDIA was sky high, really, in comparison to a lot of the other tech stocks. So that in itself is understandable why that would be the bigger move out of all the three indices. You've got Bitcoin, that's a huge move on Bitcoin, top to bottom 33%, but that's nothing new to the crypto space. There isn't a single person that is sort of investing for their pension that's of a certain age that is going to be positioning a huge amount of their portfolio in Bitcoin. So we're used to that kind of volatility for all the hodlers out there that are involved in crypto. So it's kind of like, well, that's not really much of a collapse, is it really? That is recoverable quite easily in Bitcoin. But then look at markets like gold. Gold is only 4%, just under 5% down top to bottom on that move. Well, I thought in times of crisis, the gold market is the one where everyone's supposed to flood to. Well, the evidence doesn't suggest that at the moment. It certainly doesn't. We've got a bit of dollar strength in there. Maybe that's a bit of a safe haven thing. But then look at the Japanese yen. That's where we've got this unwinding now of a carry trade. So the euro dollar is only moved top to bottom 2%. Well, I mean, that's nothing. I mean, that's absolutely nothing. That in itself is not a crisis. Dollar yen, you could describe, well, there is an interest rate differential impact. So what I mean by that is that once we are going to get a cut from the Federal Reserve in September, most economists and most market analysts would agree with that, and I would say that that is probably about right. But if you do get that cut from the Federal Reserve, there's a tendency for people to then say, okay, the carry trade, because it's so profitable to be long dollar yen, that interest rate is going to come down, so therefore people don't want the positions anymore. Well, actually, it's not true, because the Japanese are only normalizing it at a very, very slow rate. So even if we do get a cut from the Federal Reserve, all that turns dollar yen into is a buy the dip type territory, unless we've got another crisis, because of course the Japanese yen is a safe haven currency. So that's quite an understandable move, 12% on dollar yen. But even then, dollar yen was pushing 164, 165, pretty high systemically for the last sort of like decade. So we've not really unwound that much of it. It's hardly a huge unwinding of the carry trade yet. That's what I think. Okay, so this is what you got to do. When you have got a market like this, then let me just go back to that dollar yen chart, excuse me, you go back to the dollar yen chart, when you see this kind of move, this is the stuff that nobody will tell you what to do. Look at the bottom of the move, look at the size of the move, and then go left and look at the last time that we were at those prices. And you will really surprise yourself at how the size of the move contain relative to the last time that we were there. And it's usually not that long ago, and it's pretty much the same in most of these instances. So if you look at this next chart here, this is what I'll put on this one here. So the last time we were at those prices at the bottom move on the Dow Jones was June. Well, that's not long ago, so 8 weeks ago. The S&P 500, April. The NASDAQ, April, 12 weeks ago, something like that. Not that long ago, just getting in towards the end of the spring into the summer. Bitcoin, a little bit further out on the curve. We were last at those prices in February, but still we are contained within our yearly range. Gold and Eurodollar, July. So it's only like the start of August, so we've not really moved very much at all in terms of distance, in terms of price, and then also the amount of time that we've had to actually move in those markets. Dollar yen, yeah, that's probably one of the more extreme ones. Back in January, we're at those prices, but still we are contained within our yearly range. That is really, really super important, because if you're going to get a market crash, you're going to start moving. If you imagine a yearly candle chart, you've got to start taking out those lows. Well, we've not started. We've not even done that yet. So this is the kind of context that is always missing from the noise. And that is why doing this kind of factual research as a trader is so valuable, because it helps you stand aside from the noise. Now, I'm not saying that the markets are going to rally from here, and I'm not saying that the markets are going to crash from here. I genuinely don't know. I'm a commercial hedgers follower from the CFTC, and I know that they're still positioned for the stock markets to rally at the moment, you know. So this could potentially look like a pullback. Is it? I really don't know. But the point is that when you're in the heat of the moment and things are falling apart, you never ever consider this detail. Never. And you never look at the chart practically and say, well, where are we and how bad actually is this situation? My argument would be that it's never quite as bad as what you're being led to believe. What's that spinal tap phrase? Dialed up to 11? Bloomberg and CNBC totally dialed it up to 11 every single day. Why? Because they want it to be exciting. They want it to make it seem like there's opportunities or you need to take action, because the industry works on turnover, you see. That's why. Always take that into perspective. So never ever forget that speed in markets is not distance. And what I mean by that is that the rate at which you're moving can really catch your attention, can really make you freeze if you've got a leveraged position on. But it doesn't necessarily mean to say that things are collapsing. It really, really genuinely doesn't. Also, as well, remember that market exists in the market on the y-axis, on the price. Market is in the market at prices. Once it's been placed in there, it's kind of forgotten about from a time point of view, but it still exists. It doesn't change its price once money's gone into the market. So therefore, you can have a market that comes all the way back down to where there was a huge amount of volume going in and never really move much past it. What's happened is that the speed at which it's been moving into that area has caught you off guard. It's really, really super important context. Let's look at the next aspect, and that is talking about a market crash. Well, what does this mean? I mean, it's a word I've heard quite a lot over the last couple of weeks with those non-farm payroll numbers coming out. How would you define a market crash? What would you do? I mean, everyone will have different definitions of it. What is it? Is it the actual price, where we were last week versus where we are now? Is it the rate of change, the speed at which we've actually changed those prices? Is it the change in the sentiment? Is it the market dynamics? Is that how we define a crash? Is it a change in market psychology? Is it the start of a bear market? Or is it the end of the bear market, the crash? Where does that come? This is the stuff that none of these journalists and stuff will actually talk about. But it's really, really super important. Now, I can tell you my own feelings and thoughts on this, and there will be people that will argue against it. That's okay. That's fine. But for me, the crash in the market really comes from a loss of confidence, and that confidence doesn't come from a change in direction. It comes after the change in direction, once everything has settled down and the market psychology has breathed a sigh of relief. That's usually basically your cliff edge, basically. And then once you go over the cliff edge, the loss of confidence that comes from that is usually where the market crash comes from. If you want to start getting technical about it, it's an unwinding of leverage. I'm a big fan. I always have been a big follower and a big fan of George Soros. He's a very, very, very interesting guy. It's worth studying his work and what his concept of reflexivity, of how markets unwind after a booming credit. And it's usually credit in the market, leverage in the market, which causes the boom and then the subsequent bust. That is usually what then creates the unwinding effect, which creates the feedback loop, which then pushes into a crash. That is how I would see it. Not just a corrective move from the highs, from the all-time highs in a lot of markets. That's the way I would look at it. So if you think about it like this, I've just drawn a rough diagram out, which kind of just, this is not the market. This is just, I'm just trying to illustrate the point. The point is you've got an uptrend here, and you've got you've got to move to the high, and then you've got an unwinding of that high, which is basically at a faster rate of change. But in terms of the structural integrity of the trend, you've not actually taken out the swing low here. So we're still technically within an uptrend. We've got an expansion of volatility, but we've not changed that much. It can look and feel like horrendously, volatile if you're on a 5-minute time frame right in the middle of this somewhere, but it's not actually a market crash just yet. The crash usually comes after. So my point is that the crash is not the first wave down. I'm not an Elliott wave guy, but the crash is not a first wave down. The crash usually comes after, once everybody is starting to fish for the bottom and says, phew, that was close, we got out of that one, and then the rug gets pulled, confidence then gets lost, and that is where you get your move. So study some Richard Wychoff. It's very, very got some very, very good opinions on how markets create uptrends and then create downtrends, accumulation and distribution, all of that stuff is very, very important. But this is not the crash. It's just not. And that's essentially what we've been having in the markets. It's this element here that occurs after the first move down. That is where we would define a crash. Okay, so let's talk about the next aspect, and this is catching falling knives. Now, most people that are new to markets, they end up in a strange frame of mind where the market starts, where they counter trade all the time, and they're always looking for low risk opportunities. And most retail traders will fall into this trap at some point, and that is where the market goes up and they're trying to short it. The market comes down and they're trying to buy it. And then that's all great and that's wonderful as they keep, and they say, well, I'm a rotational trader, yeah? So that's all wonderful until the market starts to move down and then they buy the low, and then it doesn't go back up, and then they buy the next low and the next low and the next low, and they end up in this horrible cycle now where they can't get short the market. They keep fishing for the bottom. So it's like a knife falling down really fast and you're trying to catch it and it hurts you. So most retail traders, ironically, they don't blow up in the move that moves against them. They blow up or they lose their accounts because they suffer death by 1,000 cuts, because they're constantly trying to fish for the bottom on all these price moves. And this is basically what it looks like. If you've been doing any trading for a while, you'll totally understand what I'm trying to get at with this. And everyone falls into the trap at some point, and it's where you're trying to scoop the bottom. So you see markets careering down like this, and then they'll be, they'll look for, that's a low risk opportunity. They'll look left, find a bit of support, and then they'll buy with a very, very tight stop loss, and they'll get hammered out. And then it makes another leg lower, and they do the same thing again, and they buy the next low, and then it rallies a little bit, and then it goes down again. It washes them out, and they've got a tight stop loss on each time, and they'll end up hemorrhaging their accounts slowly into the market over a period of a few days, a few weeks, something like that. And what happens then is they end up damaging themselves. They end up really hurting their accounts, not by one move that's killing them, but by this process of constantly trying to catch the bottom of the market. And what they see is that they see all of these as being very low risk opportunities. Well, the market's come down very quickly, hasn't it? Yeah. So I want to buy this low, and then I got a tight stop loss, and that's it. Happy days. I'm going to make myself rich with it because I'm the guy that bought the bottom. But whilst that may look like a low risk opportunity, it's also a very, very low probability opportunity. So the chances of that technique working, of you being able to pick which bottom is the bottom that's going to work, Very, very slim, and you'll probably more likely do yourself more damage than you will actually benefit from being the guy that happens to buy the bottom. That tends to be the thing that really culls most retail traders, so just be aware of it. There's some fixes of that, and when we move into doing educational content on the website, we're going to put some decent information around understanding this and what you can do to counteract these kinds of behaviors, because it's useful stuff for traders. But yeah, we will be doing that when we start doing educational stuff at FTUK. Okay, so let's look at the final aspect. Which prop traders handle these kinds of market conditions best? Now, this is not a complicated question, and there's no secrets. It's actually a very simple answer, and it's a bit obvious, to be honest with you, but I want to just put some ideas around it that maybe just expand on the subject. And it's basically the guys that can manage their risk best. And that sounds old school. Yeah, of course. Yeah, it's obvious, isn't it? But you'd be surprised at how many prop traders make these kinds of market conditions 10 times harder because they just neglect the element of managing their risk. Now, we should all be managing our risk in the market every single day when we are trading. We are in the risk business, so the people that tend to succeed are the ones that can manage their risk. But there's some very specific things in these kinds of conditions which I think can give us extra information and extra context, which you should definitely consider. So if you again, this is an exercise that anybody can do, and this is the sort of exercise in these kinds of markets that you should be doing, because it's all about surviving in any market condition, whether the markets are nice and calm and just trending or sideways, or whether the markets are really kicking off and we've got an expansion of volatility. So this is one of those equity markets. I think is the Dow Jones from on a daily time frame, and this is just a little section of candles that I took a screen grab from. You can see we've got a bit of an uptrend and we've got a downtrend, a little bit of sideways at the top, or the pullback there in the middle. The point is, if you were to take these trends and remove the trend itself, remove the sideways bit at the bottom, and line all of these candles up, what would you get? You'd get this. You'd get something that looks a little bit like that. A market with no trends, either up or down, and it's not even really ranging, it's just a placement of candles. But what we are seeing is we're seeing this. We're seeing the tops and the bottoms, the average overall top and bottom of the overall range. Average true range, if you want to look like that, or just an estimation of the total range. So whether we are trending up, you've got a sort of like a range to deal with. Whether we are trending down, you've still got a range to deal with. If we're going sideways and you were to take every single candle and line it all up, what is that number? What is that actual distance there? There's a tendency for most retail traders to be reactive. And when you're reactive in markets, it means you're always trading in the middle. So if you're trading in the middle of all of this stuff, whether you're going up or whether you're going down, whether you're long or whether you're short, it means that your stop's always going to be on the other side of this overall range in the market. When it is, it has to be on the other side, but most retail traders, because they're leveraged, their stop will be placed just at the edges of these. So the reason for making this, putting this into this workshop is very important. If you want to survive expanded ranges of volatility, market dynamics where we've got the kinds of things kicking off that we've got at the moment, it's really important to understand this, because you're working with leverage all the time. Now, I could say, well, deleverage. Yes, you can deleverage, but what you've really got to understand is that whatever that range is, you're more than likely, if you're being reactive with your trading strategy, to end up trading in the middle, which means that whatever this overall distance is, half of that distance is probably the capacity of what you can handle. So at FTUK, in our prop accounts, you can't have one position that's more than 2%. So my point is that you should position size for where you believe the overall relative volatility in the market, that range, where that currently sits. If you do that and your stop is on the other side of that rather than on the other side of a bit of market structure, you're more than likely going to be able to find it a little calmer and a little easier to navigate. For most people as well, that's going to mean having to deleverage because of the nature of the way that the prop accounts work. But it's the kind of detail that no one's ever going to tell you. And it's absolutely critical. It's really super important. So there's quite a bit in there. And I don't want to be I can't really honestly say whether I believe that we are in an environment where we've got a market crash, or whether we're just basically buying a pullback. And I would be foolish to try and call that, because nobody really knows what's going to happen next. But what I have learned in years and years and years of trading is that the noise box that hits you when you're absorbed in it day to day, it can lead you to not think as clearly as you should. And a lot of those practical exercises and ways of looking at the actual price action, always ask yourself, okay, this looks bad. How bad actually is it in relative terms? Because if I'm listening to this guy over here, he's panicking like mad, and everything is falling apart. Is it really? You always got to have that perspective in mind. Now, there's a phrase that I really, really like, a quote from one of my favorite traders, and that is Paul Tudor Jones. And this is where I will leave you with this. And he famously said that it's never the move that kills you, it's always the size. And because we work with leverage, what he's meaning is you've got too much leverage on, take some leverage off, and you're more than likely to be able to work with what you've got, rather than seeing your money yo-yo around incredibly quickly, because that is usually what sets people off on the wrong path, and it usually causes most people the most problems. It's never the move that kills you, it is always the size. Okay, so finally, just a quick recap on our weekend offer. 30% off all of our accounts. It's not going to be around for much longer, only till Monday, because we've got the new accounts and the new website coming very, very soon in the next couple of weeks. That's it. That's everything I've got for today. So thank you very much for joining us. I hope you're managing to survive and navigate the markets in a good fashion. Have a great weekend, and we will catch you all next week.